The global Forex market never sleeps, and neither do the forces that drive it. Every tick of the price, every sudden spike or dip, is often influenced by larger global events, some expected, some totally out of the blue. If you're a trader, understanding these global events can give you a powerful edge. So let's dive into the top 5 global events that move the Forex markets and how you can stay one step ahead. First on the list, interest rate decisions. Central banks like the Federal Reserve, the European Central Bank, or the Bank of Japan have massive influence on currency values. When a central bank raises or cuts interest rates, it changes the yield on that currency, which in turn changes how attractive that currency is to investors. For example, if the Fed raises rates, the US dollar tends to strengthen because higher returns attract more capital. Traders need to anticipate these moves and react quickly when announcements are made. Next up, geopolitical tensions, wars, territorial disputes, political instability. These can cause massive volatility. Just think about how conflicts in the Middle East often spike oil prices and affect commodity currencies, or how a single tweet from a political leader can rattle markets in seconds. In times like these, risk sentiment takes over, and safe haven currencies like the Swiss franc or Japanese yen suddenly become highly desirable. Volatility is high, but so are the opportunities if you know how to read the market. Third, we have economic indicators. GDP reports, employment numbers, inflation rates. These monthly or quarterly data points are like report cards for an economy. A surprise in these figures can shock the market. For instance, better than expected job numbers in the US might cause the dollar to jump. But the key here isn't just the data, it's the expectation. Traders often position themselves before these releases, and the actual market reaction is based on how the data compares to forecasts. Fourth is natural disasters and pandemics. While these are less predictable, their effects on Forex markets can be immediate and severe. The COVID-19 pandemic is the most recent example. It caused global markets to plunge, and central banks worldwide scrambled to inject liquidity, slashing interest rates and implementing quantitative easing. In such scenarios, sentiment swings rapidly, and the need for real-time trend identification becomes crucial. And finally, number 5, trade policies and tariffs. Changes in trade agreements, new tariffs, or sanctions can reshape the global economy almost overnight. Look at how the US-China trade war affected global currencies. Currencies of countries heavily dependent on exports or commodities were among the most affected. As a trader, being aware of upcoming trade talks or announcements can help you avoid being caught on the wrong side of a sudden price movement. So, how can you keep up with all of this? That's where tools like the Apex Trend Indicator come into play. Built specifically for Forex traders, it helps identify major trend shifts across multiple pairs and timeframes. During high-impact news releases or unexpected geopolitical developments, the Apex Trend Indicator automatically adjusts to market volatility. It gives you non-repainting signals, real-time alerts, and even visual arrows on the chart to show you where the trend is heading. Imagine waking up to a fresh buy signal on EUR/USD after a surprise ECB rate hike, or catching a sell signal on JPY pairs right before geopolitical tensions escalate in Asia. With the Apex Trend Indicator, you're not just reacting, you're prepared. Trading in a global market requires more than just following a few charts. It demands an understanding of the world and a tool that keeps you synced with market movements. At FX Limit, we believe that knowledge, combined with the right tools, empowers traders to stay ahead. So whether it's central banks making a move or a headline shaking the world, make sure you're trading with confidence, precision, and clarity. That's the edge that turns potential into profit.